we have a special guest today, James Butterfield. He's the head of research at Coinshares. James, welcome.
Hi there.
First question is, despite the global economic challenges, how do you see the future of digital assets?
Well, you have to look back to, say, 2021. I don't want us to go on too long, of course, but it's important to go back that far and realize what popped the Bitcoin bubble back in 2021. There was irrational exuberance, but what popped it was probably rising interest rates. Now, in the US, now this makes sense. Bitcoin is a store of value of sorts, and rising interest rates tend to be quite bad for stores of values. And that really led, obviously, to a lot of bad actors, but bad actors being revealed. But I think that really gets in the way of what fundamentally Bitcoin is. It's a store of value. I'd probably better phrase as a non-sovereign store of value. So it's something the state can't confiscate for you. So when you think about the future of Bitcoin, you can look just to the recent past and say, okay, well, where is Bitcoin volume growth really picking up? And it is in emerging markets. So I think Bitcoin is becoming this emerging market story. If you look at countries with dramatic currency depreciation, Turkey is actually a really good example of this. It has huge currency depreciation, and people see Bitcoin as an anchor. I mean, take Argentina as an example. Bitcoin is, in Argentine peso terms, is at an all-time high. So I think that trend in the near term is going to continue. And then later on, we'll start to see greater adoption from the developed markets.
Mm-hmm. And US Securities and Exchange Commission is going after some crypto exchanges such as Coinbase and Binance. What do you think from the global perspective, what the countries needs to do on the regulation, or how would work on this issue? Because there is a lot of discussion going on globally.
Yeah, so if you look on a relative basis now, the United States and the SEC looks very heavy-handed. The SEC have a hammer and they're looking for nails to hit. Unfortunately, that hammer is not appropriate for digital assets. The Securities and Exchange Commission laws were set in the 1930s, and they are applying laws that old to digital assets. It doesn't make sense. But really, they're waiting for legislation from Congress really to change before they can change their rules. It seems heavily handed, perhaps unduly so. And the reality is, if you look across the pond in Europe, they have MiCA, which is markets in crypto assets, which is a lot more friendly and a lot more constructive in terms of digital assets and a lot more appropriate. And we are seeing a bit of a brain drain from the United States. If you look at crypto volumes, they were peaked at 85% at the start of this year in the United States. They're now down to 67%. So businesses are leaving the United States because of this heavy-handed actions from the SEC. That said, if you look in Europe, we're seeing an improvement, a pickup. We're also seeing much friendlier environment from places like China and Hong Kong in particular, where they've just launched their first Bitcoin ETFs, and they're increasingly friendly towards crypto assets.
And you do have a digital asset fund flows report recently. What are the top 3 highlights, James, for that report?
We had 9 consecutive weeks of outflows totaling over $400 million. But in the last 2 weeks or week and a half, suddenly after the announcement that BlackRock were launching an ETF, a bid for an ETF in the United States, that has really swung sentiment around. The largest asset manager in the world suddenly deciding they want a Bitcoin ETF after 3 years ago where they said they thought it was complete rubbish. That has really swung sentiment around, and we've seen nearly all those outflows, those 400 million outflows, corrected in the last week and a half. So that really has swung sentiment around.
Mm-hmm. And since you little bit mentioned about Turkey, any highlights from the Turkish crypto markets, James?
Yeah, I mean, the only thing I look at is the Turkish lira against the trading pair Bitcoin and Ethereum. And over the last year, we've seen volumes more than double against the Turkish lira and Bitcoin, which suggests, despite the government's resistance to Bitcoin, that people are finding ways of trading it, are looking at it as a form of store of value. And I only think, given the economic malaise that Turkey is facing right now, that something like Bitcoin will become increasingly more popular.
Mhm. And my last question is, European Central Bank, Federal Reserve, when we look at the interest rate, it seems like there might be another hike. So how does interest rates impact the crypto market?
Yeah, so imagine a store of value is something that is of finite supply that is priced in dollars. And you always have to think of a store of value. What it's competing with is something like treasuries in the US. When interest rates rise, actually treasury yields rise, making them relatively more attractive to something that doesn't yield much, i.e. Bitcoin. Conversely, when rates fall, Bitcoin tends to do quite well. Now, yeah, I think in this July, the FOMC will hike rates again, and maybe in September or August. In the ECB in Europe, there's a continued inflation problem. The challenge, though, you have is you hike rates this aggressively, things start breaking in the economy. We've seen big problems in the US banking sector. So yes, they'll probably continue hiking. My view is it's probably, in hindsight, will have been a mistake to do that. Because a lot of macroeconomic data, whilst it looks fine now, tends to be quite lagging. And as a consequence, I think history will say that it was a mistake to carry on hiking rates. So yes, we probably will weigh a little bit on Bitcoin prices, but I am seeing it, the Bitcoin prices kind of shrug off the prospect of further higher rates, because I think they're reading into this idea that the banking sector, everything's not okay in the US, particularly the banking sector.
James, thank you so much for your time.